The lights still come on every morning. Escalators cycle through empty floors. Climate systems maintain rooms designed for thousands. Security teams patrol corridors that never filled. Outside, access roads lead to entrances no one uses. This project wasn't cancelled. It wasn't damaged. It wasn't unfinished. It was completed, inspected, and fully operational. Every system worked. Every department was staffed. Every cost was accounted for. And yet, once operations began, the project became impossible to keep open. So the real question isn't why this mega project was abandoned. The question is harder. Was it abandoned because it failed, or because it worked exactly as designed? Once construction finished, this project was supposed to be safe. For years, the narrative around mega projects focuses on construction risk. Will the foundation hold? Can the materials withstand stress? Will the systems integrate properly? The assumption runs deep through planning documents and investor presentations. Once you cut the ribbon, the hard part is over. This assumption is wrong. The reality is that completion doesn't end financial exposure, it transforms it. During construction, money flows out in predictable increments. Labor, materials, equipment, each with contracts and schedules. The spending is large but finite. A construction budget has boundaries. Operations have no such limits. The moment a mega project opens, a different clock starts running. Utilities begin accumulating charges. Staff arrive expecting paychecks. Maintenance schedules activate. Insurance premiums come due. Cleaning crews start their cycles. Security operates around the clock. These costs don't care whether anyone actually uses the facility. A finished mega project is not a static asset. It's a living system that consumes resources continuously. The consumption rate was calculated during planning, written into pro forma documents that promised the revenue would exceed the expense. Those calculations assumed one critical variable would hold true. It didn't. Projects like this are built by spreadsheets, not vision boards. Mega projects don't emerge from individual ambition. The scale is too large for private wealth alone. Instead, they materialize from the intersection of institutional capital, public backing, and development expertise. The funding typically involves pension funds seeking stable long-term returns, sovereign wealth looking to deploy reserves, insurance companies matching long-duration liabilities with long-duration assets. Private equity may take positions. Banks provide construction financing. Government agencies often guarantee loans or provide tax incentives to justify the public benefit. These entities don't fund dreams, they fund models. Financial models built on assumptions about occupancy rates, rental income, operating costs, and exit valuations. The models run sensitivity analyses, they test downside scenarios, they build in contingencies. The contingencies are never enough. Development teams operate at the intersection of finance, engineering, and political navigation. They understand zoning, construction logistics, labor markets, and the choreography of bringing massive capital together for a single purpose. Their expertise is real. Their track record demonstrates capability. Yet expertise in building doesn't guarantee expertise in operating. The skills required to construct a complex facility differ fundamentally from the skills needed to fill it with paying users. This gap shows up in subtle ways during planning. The development team presents detailed construction timelines with milestones and risk registers. The operating assumptions occupy a few slides near the end of the deck. Projections for tenant mix, absorption rates, and operational efficiency are presented with confidence but rest on comparisons to other markets, other buildings, other circumstances. The confidence is misplaced. Because the fundamental question isn't whether you can build it. Money and engineering can solve almost any construction challenge. The question is whether anyone will pay enough to justify keeping it open once it's finished. That question was asked. The answer was yes. The answer was based on assumptions that would prove fatally optimistic. The real project wasn't the building. It was the cost structure. Every mega-project rests on an economic foundation. Revenue must exceed operating costs by enough to service debt, provide returns to equity, and fund capital reserves. The margin between income and expense determines viability. This margin depends on understanding fixed versus variable costs. Fixed costs persist regardless of occupancy. Structural maintenance, property taxes, insurance, security, base utilities, and skeleton staff all continue whether the building is full or empty. These costs were calculated during planning and seemed manageable against projected revenue. Variable costs scale with usage. Incremental utilities, cleaning for occupied areas, additional staff, supplies, and services that expand as more tenants arrive. The model assumed these costs would remain proportional to revenue, maintaining healthy margins at any occupancy level. The reality was different. Many costs that planners categorized as variable turned out to be functionally fixed. A half-empty building still requires climate control throughout to prevent deterioration. Security can't patrol only occupied floors. Elevators, escalators, and common area maintenance operate based on the facility's size, not its occupancy rate. The cost structure became a trap. Expenses remained near full capacity levels, while revenue came in at fractions of projections. Every month of operation consumed capital. Every quarter made recovery harder. The financial model had built-in occupancy ramps. The projection showed absorption curves moving from opening day toward stabilization over 18 to 24 months. Industry benchmarks suggested this timeline was conservative. The benchmarks were wrong for this specific circumstance. Because the model underlying every projection contained an assumption so fundamental that it appeared in bold on presentation slides, repeated in investment memos, and formed the basis of every sensitivity analysis. That assumption broke first. Scale was supposed to make everything cheaper. The economic logic of mega-projects rests on scale efficiency. Larger buildings spread fixed costs across more revenue-generating square footage. Bulk purchasing reduces per-unit costs. Shared systems and centralized management create operational leverage. This logic works until it doesn't. The problem emerges when scale crosses a threshold where complexity costs overwhelm efficiency gains. A 50-story building isn't simply a 10-story building times 5. It's a different organism with different requirements. Vertical transportation becomes exponentially more complex. You can't simply add more elevators. Each elevator shaft consumes rentable space. At extreme heights, express elevators, sky lobbies, and zone systems become necessary. These solutions work but cost significantly more per square foot than conventional systems. Mechanical systems face similar scaling challenges. HVAC for a megastructure requires redundancy. A single air handling unit failure can't compromise an entire floor. This means multiple systems, sophisticated controls, and constant monitoring. The equipment is more expensive. The expertise to maintain it is harder to find and costs more. Structural requirements intensify with scale. The bottom floors of a very tall building support immense weight. This requires stronger materials, deeper foundations, and engineering precision. The cost per square foot at the base far exceeds the cost per square foot at mid-height. Facade complexity increases with scale and architectural ambition. Large, continuous curtain walls create thermal and acoustic challenges. Maintaining exterior surfaces at height requires specialized equipment and trained personnel. Window washing becomes a significant line item. Life safety systems must meet higher standards. Fire suppression in tall buildings requires pressure-regulated sprinkler zones, refugee areas, and sophisticated smoke management. Egress becomes more complex with greater vertical distance. Code compliance for megastructures involves systems that simply don't exist in conventional buildings. All of these scaling costs were known during planning. Engineers calculated them, contractors priced them, the development budget absorbed them. What wasn't fully appreciated was how these complexity costs would persist into operations, creating an expense baseline that required corresponding revenue at a scale few markets could actually deliver. The mega project achieved scale. The market couldn't absorb it. Every projection depended on one number staying true. The number was demand. Specifically, demand at the projected price point, in the projected time frame, in sufficient volume to reach the occupancy levels that made operations viable. During planning, demand analysis seemed thorough. Consultants surveyed the market. They counted potential tenants, analyzed demographic trends, studied competing facilities, and projected absorption based on historical patterns. The analysis contained a fundamental flaw. It assumed the market would treat this mega project as simply more supply within an existing category. More office space, more residential units, more retail square footage. The model treated it as quantitative expansion within a known market dynamic. The reality was qualitative transformation. A mega project doesn't just add supply, it changes the market. The scale itself alters competitive dynamics, tenant expectations, and pricing possibilities. Conventional market analysis fails to capture these effects because they emerge from the project's unique characteristics rather than from historical patterns. The first signal appeared in leasing velocity. Pre-leasing commitments had reached targets during construction. These anchor tenants validated the concept and secured construction financing. Their commitments appeared in marketing materials as proof of demand. What the materials didn't emphasize was the concession packages required to secure those commitments. Rent abatements, tenant improvement allowances, and flexible terms that looked acceptable when projected against future market rate revenue. Post-completion leasing told a different story. Prospective tenants toured the facility, expressed interest, and then didn't sign. Follow-up revealed consistent patterns. The space was impressive but larger than most tenants needed. The location was striking but not optimal for their specific operations. The amenities were extensive, but added costs they preferred to avoid. The megaproject had been designed to attract and serve thousands of users. It succeeded in attracting attention, but failed to convert that attention into committed occupancy at the required pace and price. The absorption curve flattened. Months passed without material progress toward projected occupancy levels. Revenue remained far below the line required to cover operating costs plus debt service. Management responses followed predictable patterns. Marketing intensified. Sales teams expanded. Concessions deepened. These measures produced incremental improvements but couldn't overcome the fundamental mismatch between what the project offered and what the market actually wanted at the price required for viability. Each month of low occupancy made the financial situation worse. Debt service continued regardless of revenue. Operating costs consumed reserves. The window for achieving stabilization was closing. The assumption that broke first wasn't about construction capability or operational execution. It was about demand. The market existed in theory, but not in sufficient practical reality. And empty capacity, it turned out, was still expensive. Unused space doesn't stop costing money. The financial model had treated vacant space as simply unrealized revenue. The cost side of the equation assumed that unoccupied areas would incur minimal expense. Climate control could be reduced, lighting could be minimized, cleaning could be deferred. Physics and practicality said otherwise. A building designed as a unified system can't easily be subdivided into occupied and unoccupied zones. HVAC systems sized for full capacity don't scale down efficiently. Running them at partial load often costs nearly as much as full operation while risking equipment damage from cycling outside design parameters. Vacant floors still require climate control to prevent deterioration. Temperature and humidity swings damage finishes, promote mold growth, and accelerate material degradation. Mothballing space costs less than full operation, but far more than zero. Security can't simply ignore empty floors. Unoccupied space attracts unauthorized access, creates liability exposure, and requires regular patrols. The security budget scaled with the building's size, not its occupancy rate. Common areas and building systems operate based on total square footage. Elevators, lobby areas, parking structures, and utility infrastructure all require maintenance regardless of how many tenants actually occupy the building. The financial impact was severe. Operating costs that were projected to run at perhaps 35% of revenue when the building reached stabilized occupancy were instead consuming 90% or more of actual revenue at current low occupancy levels. Revenue was coming in at perhaps 40% of projections. Costs were running at 80% of full occupancy levels. The gap consumed reserves at an alarming rate. Debt service added another layer of pressure. Construction loans had converted to permanent financing at completion. Principal and interest payments came due monthly, indifferent to occupancy rates or market conditions. The combined burden of operating costs plus debt service created a monthly cash requirement that revenue couldn't meet. Equity injections filled the gap initially, but those capital calls eroded investor patience and willingness to continue funding losses. Property taxes presented another fixed cost that couldn't be reduced. Assessed value was based on construction cost and comparable sales, not on actual financial performance. Tax bills arrived annually with amounts that made sense against projected revenue, but looked devastating against actual income. Insurance followed similar logic. Coverage requirements were based on replacement value and liability exposure, both tied to the building's physical characteristics rather than its financial performance. Premium reductions required either accepting less coverage or demonstrating risk improvements that were difficult to achieve in a partially occupied mega structure. Every cost category revealed the same pattern. Expenses designed to support full operations couldn't easily scale down. The building was built to serve thousands. It cost almost as much to serve hundreds. The efficiency that scale was supposed to deliver had inverted. The mega project size became a liability rather than an advantage. And time was making everything worse. The day the doors opened, the meter started running. Completion triggered contractual obligations that had been deferred during construction. Utility accounts activated with monthly minimums based on connection capacity. Janitorial contracts began full cycles. Service agreements for elevators, HVAC, fire systems, and building automation went into effect. Staffing requirements materialized according to pre-planned organizational charts. Property management, engineering, security, leasing, accounting, and administrative personnel all reported for duty. Payroll began its relentless bi-weekly rhythm. The scale of staffing requirements reflected the building's design capacity, not its actual occupancy. A mega project of systems require trained operators regardless of tenant count. The engineering staff needed to maintain complex mechanical and electrical systems couldn't be proportionally reduced. Security coverage was based on building size and access points, not occupancy rates. Energy costs started accumulating immediately. Electricity for lighting, elevators, pumps, and controls. Natural gas for heating and hot water. Water and sewer based on minimum service charges plus actual usage. These bills arrived monthly with amounts that reflected the facility's massive infrastructure. The energy profile was particularly problematic. Mega projects are designed for efficiency at full capacity. Motors, chillers, boilers, and air handlers all operate most efficiently within specific load ranges. Running these systems at partial load reduces efficiency and increases per unit costs. Base building operations alone consumed significant energy. Emergency lighting, exit signs, fire alarm systems, elevator standby power, and parking garage ventilation all ran continuously. Common area HVAC maintained temperature and humidity in lobbies, corridors, and amenity spaces regardless of whether anyone was using them. Maintenance cycles began according to manufacturer specifications and building codes. HVAC filters required regular replacement. Elevator systems needed monthly inspections. Fire suppression systems demanded quarterly testing. These requirements were non-negotiable and sized to the building's scale. Landscaping and exterior maintenance added their own costs. Large sites require regular groundskeeping. Parking areas need sweeping and striping. Exterior lighting operates on timers and sensors. Snow removal, when applicable, scaled with paved area rather than occupancy. Technology systems required constant attention. Building automation, security cameras, access control, telecommunications infrastructure, and internet connectivity all needed monitoring, updates, and occasional repairs. The IT requirements for a mega-project rivaled those of a mid-sized corporation. Consumables accumulated as ongoing expenses. Cleaning supplies, paper products, light bulbs, HVAC filters, and spare parts for various systems all required regular replenishment. Bulk purchasing provided some discounts, but couldn't eliminate the fundamental cost of maintaining operational readiness. Professional services added another layer of monthly expense: legal counsel for lease negotiations and compliance issues, accounting for financial reporting and tax preparation, marketing and public relations to attract tenants, consulting for specialized building systems. These services were essential and expensive. The total monthly operating cost, when all categories were summed, reached a number that had looked manageable in the financial model against projected revenue. Against actual revenue at low occupancy, the number was devastating. Every month, the difference between revenue and operating costs came out of reserves. Every month, those reserves diminished. Every month, the pressure to find a solution intensified. But the solutions available were constrained by economic realities that wouldn't bend to desperation. Charging more would have guaranteed failure. The obvious response to revenue shortfall was to increase prices. Higher rents, steeper lease rates, premium charges for services and amenities. Simple economics suggested that price increases could close the gap between income and expense. The market rejected this logic. Pricing for commercial real estate operates within competitive dynamics. Tenants compare options across multiple facilities. Location, quality, amenities, and lease terms all factor into decisions. But price remains the primary filter. The mega-project's pricing was already at market premiums. The development team had justified higher rates by pointing to superior quality, modern systems, and extensive amenities. Marketing materials emphasized these advantages. Prospective tenants acknowledged the quality but balked at the premium. Competitive facilities offered adequate space at lower costs. The delta between premium pricing and market alternatives exceeded most tenants' willingness to pay for incremental quality. Raising prices further would have widened this gap. Leasing velocity, already slow, would have stalled completely. The few tenants willing to consider the facility at current rates would have walked away if faced with increases. Market conditions constrained pricing power. The economy was showing mixed signals. Some sectors were expanding while others contracted. Tenant demand overall was softer than projections had assumed. In this environment, landlords across the market were competing aggressively for the limited tenant demand that existed. The mega-project couldn't escape these dynamics through sheer quality. Being the best facility in a market doesn't guarantee tenants if your pricing exceeds what the market can bear. Premium positioning required premium demand. That demand was projected to exist based on economic forecasts and demographic trends. The projections were optimistic. Actual demand came in below the levels needed to support premium pricing at the required volume. Price elasticity worked against the building. Raising rates by 10% wouldn't simply reduce demand by 10%. It would likely reduce demand by significantly more as prospective tenants shifted to lower-cost alternatives that met their basic needs adequately. The mathematics were unforgiving. Even substantial price increases wouldn't generate enough additional revenue to offset the loss from reduced occupancy. The net effect would be lower total income, making the financial situation worse rather than better. Existing tenants provided another constraint. Lease agreements locked in rates for multi-year terms. Rent escalations were built into those agreements, but at modest percentages tied to CPI or fixed annual increases. Attempting to renegotiate higher rates mid-term would have triggered tenant departures, creating immediate vacancy. The few anchor tenants who had committed during pre-leasing held particularly favorable terms. Their rates were below market as a concession for committing early and providing validation during the construction phase. These tenants were critical to maintaining even the minimal occupancy levels achieved. Losing them would have been catastrophic. Market comparables provided transparent pricing signals. Prospective tenants knew what competing facilities charged. They could calculate cost per square foot, compare lease structures, and negotiate from informed positions. The mega project couldn't raise prices significantly without creating obvious disparities that would be used against it in negotiations. Brand positioning constrained flexibility. The development team had marketed the facility as premium but not unreachable. Pricing had to align with this positioning. Dramatic increases would have repositioned the project into ultra-premium territory, where tenant demand was even more limited. The price ceiling was real and binding. Revenue couldn't be increased by simply charging more. The market wouldn't support it. Tenant demand wouldn't materialize at higher rates. Occupancy would fall, making the financial situation worse. But lowering prices carried its own impossibilities. Charging less would have destroyed the model. The alternative to raising prices was reducing them. Lower rents might attract more tenants, increasing occupancy and generating the volume needed to cover operating costs through aggregate revenue rather than high per-unit pricing. This strategy had fatal flaws. The financial model was built on specific revenue assumptions. Debt covenants required minimum debt service coverage ratios. These ratios compared net operating income to debt payments. Falling below covenant levels would trigger technical default, giving lenders rights to intervene or foreclose. Reducing prices by enough to materially increase occupancy would have pushed revenue below covenant requirements, even if the occupancy gains materialized. The debt structure couldn't support a discount pricing strategy. Equity investors had committed capital based on projected returns. Those returns required specific revenue levels. Significantly lower pricing would have eliminated any possibility of achieving target returns. Equity would have been impaired beyond recovery. Existing tenants created another constraint. Lease agreements contained various protections and benchmarks. Offering new tenants substantially lower rates would have triggered most favored nation clauses, requiring the landlord to extend the same terms to existing tenants. The revenue impact would have been immediate and severe. Market positioning would have been destroyed. The megaproject had been marketed as premium. Dropping prices significantly would have signaled distress, undermining the brand and making future leasing even harder. Tenants avoid facilities perceived as struggling. The message sent by deep discounting would have repelled the exact tenants the project needed to attract. Construction costs created a flaw beneath pricing. The project had cost a specific amount to build. That cost had to be serviced through debt and eventually recovered through operations for equity investors to avoid complete loss. Pricing below certain levels made mathematical recovery impossible regardless of occupancy rates. Operating costs provided another flaw. Even at maximum achievable occupancy, revenue had to exceed operating costs to approach viability. Pricing low enough to dramatically accelerate absorption would have generated revenue that couldn't cover basic operating expenses even if the building filled completely. The math was straightforward and brutal. Lowering prices by 30% might double occupancy from 40% to 80%, but revenue would only increase from 40% to 56% of original projections. Operating costs would remain near 80% of full building levels. The gap would widen, not close. Competitive dynamics constrained downward pricing. If the megaproject cut rates significantly, competing facilities would respond with their own price reductions to protect occupancy. The result would be market-wide price erosion with no sustained occupancy advantage for any participant. Premium construction and operating costs couldn't be undone. The building was built to high specifications with expensive materials and sophisticated systems. Those systems required expensive maintenance. The cost structure was fundamentally higher than conventional facilities. Competing on price against cheaper-to-operate buildings was a losing strategy. Time couldn't be reversed. The debt was in place. Operating costs were burning reserves monthly. Pivoting to a discount model would have required months to execute while hemorrhaging cash throughout the transition. The capital to sustain operations during a pricing strategy shift didn't exist. The megaproject was trapped between two impossibilities. Prices couldn't rise because the market wouldn't support higher rates. Prices couldn't fall because the financial structure couldn't survive lower revenue. Every month that passed without resolution made the trap tighter. Every month open made recovery harder. Financial distress has a momentum. Each month of losses consumes reserves that won't be recovered even if operations eventually stabilize. The hole deepens. The capital required to reach viability increases. Investor patience erodes. The megaproject entered a death spiral. Low occupancy generated insufficient revenue. Revenue shortfalls consumed reserves. Declining reserves limited capital available for tenant improvements and leasing commissions. Reduced leasing investment slowed absorption. Slow absorption perpetuated low occupancy. Each component of the spiral reinforced the others. Breaking the cycle required capital infusions large enough to fund aggressive leasing while covering ongoing operating losses. The capital required grew monthly as reserves depleted. Debt maturities created artificial deadlines. Construction loans typically convert to permanent financing with terms of 5 to 10 years. At maturity, the loan must be either refinanced or repaid. Refinancing requires demonstrated performance and stabilized operations. Neither existed. The approaching maturity created countdown pressure. If the building couldn't reach viable occupancy and prove operating performance before the loan matured, refinancing would be denied. The alternative would be forced sale, likely at a massive loss, or lender foreclosure. Operating losses accumulated into a capital deficit that exceeded the building's declining value. The original equity investment had been based on projected value at stabilization. Actual value with poor operating performance was far lower. The gap between equity invested and recoverable value widened monthly. This dynamic destroyed investor willingness to inject additional capital. Equity follows a rational calculation. Additional investment only makes sense if it can be reasonably expected to recover the new capital plus some portion of previous losses. When the gap becomes too large, additional capital simply disappears into the hole without materially improving the probability of recovery. Management faced deteriorating options. Marketing budgets were cut to preserve cash. This reduced leasing velocity further. Maintenance was deferred to reduce operating costs. This accelerated building deterioration, making the facility less attractive to prospective tenants. Staff reductions followed. Less frequent cleaning, reduced security coverage, longer response times for tenant services. Each cut saved money in the short term while degrading the tenant experience and reducing competitive positioning. The cuts created a visible downward trajectory. Prospective tenants noticed the reductions in service and maintenance. The building began showing subtle signs of financial stress. These signals discouraged leasing. Why commit to a long-term lease in a facility that might be in foreclosure within a year? Existing tenants began considering departure. Lease renewal negotiations became difficult as tenants sensed vulnerability and demanded concessions. Some tenants with lease expiration options chose to leave rather than extend in an uncertain environment. Debt service defaults became inevitable. Monthly payments exceeded cash flow. Reserves depleted to levels insufficient to cover the gap. The owner stopped making full payments, initially, planning to catch up when occupancy improved. Lenders noticed immediately. Default notices arrived. Cure periods were short. The owner couldn't cure without new capital. Capital providers saw the default and refused to invest in a project that couldn't even meet its current debt obligations. Foreclosure proceedings began. Lenders filed necessary documents. Court processes initiated. The timelines were measured in months, but the outcome became increasingly certain. During this descent, a strange calculation emerged, one that management initially resisted but eventually couldn't ignore. The cost of keeping the building open exceeded the cost of closing it down. At a certain point, closing costs less than continuing. The arithmetic was stark. Monthly operating costs were running approximately $2 million. Revenue at 40% occupancy generated roughly $800,000. The monthly loss was $1.2 million. Annually, the building consumed $14.4 million just to stay open. Shutdown costs could be calculated. Severance for staff, roughly $3 million. Lease termination costs for existing tenants, approximately $8 million. Minimal caretaker operations, including security, basic utilities, and essential maintenance, roughly $400,000 monthly or $4.8 million annually. The comparison was brutal. Continuing operations burned $14.4 million per year with no path to profitability visible. Shutdown required a one-time cost of $11 million plus ongoing minimal operating costs of $4.8 million annually. After the first year, shutdown was cheaper. After 2 years, cumulative savings exceeded $20 million. The financial logic was inescapable. This calculation assumed that keeping the building open provided some possibility of recovery. If occupancy could somehow reach 70% or higher within a reasonable time frame, continued operation might eventually break even and begin generating returns. The probability of reaching that occupancy was effectively zero. 3 years of operation had produced 40% occupancy despite aggressive marketing and significant concessions. Market conditions weren't improving. Competitive supply was increasing. The trends all pointed toward continued struggle, not sudden turnaround. Equity investors faced a choice. Continue funding losses of $14.4 million annually for an indefinite period in pursuit of a recovery that appeared increasingly unlikely. Or execute an orderly shutdown, pay one-time costs, and minimize ongoing losses while preserving remaining capital. The decision matrix was clear. Continued operation destroyed value faster than shutdown. Shutdown preserved more capital for investors, even though it meant abandoning the project entirely. Emotional resistance complicated the decision. The development team had spent years bringing the project to completion. Walking away from a finished operational facility felt like failure. Pride and professional reputation created pressure to keep trying. Financial reality overruled emotion. The investors controlled the capital. Their fiduciary duty ran to preserving and recovering that capital, not to validating the development team's vision or protecting reputations. Debt holders complicated the calculation. Shutdown would trigger immediate default since revenue would cease entirely. Lenders would foreclose. But the owner was already in default, and foreclosure was proceeding regardless. Shutdown simply accelerated an outcome that was already inevitable. From the lender's perspective, shutdown had mixed implications. An operating building, even at low occupancy, was easier to sell than a shuttered facility. But the operating losses were depleting any remaining equity that might cushion the lender's loss. Shutdown would stop the value destruction even if it complicated marketing. Regulators and local government represented another stakeholder group. A massive facility going dark created economic and political problems. Jobs would be lost. Tax revenue would vanish. The visible symbol of failed development would damage the community's image. Government officials attempted intervention. Economic development agencies offered incentives. Politicians pressured lenders to extend more time. Local media covered the situation, creating public pressure to save the project. None of these interventions could change the underlying math. The building cost too much to operate relative to the revenue it could generate. No amount of political will could alter that equation. The decision was made. Operations would be wound down over 60 days. Tenants would receive formal notice. Staff would be terminated with severance. Systems would be placed in minimal maintenance mode. Security would transition to caretaker coverage. The building would be abandoned, not because it failed to function, but because it functioned exactly as designed at a cost the market couldn't support. Once operations fail, the balance sheet changes instantly. The accounting transformation was swift and brutal. The mega-project had been carried on the books as an asset valued at construction cost, approximately $800 million. This valuation assumed successful operations would eventually generate cash flows justifying the investment. Shutdown triggered immediate impairment. An idle building generates no income and requires ongoing cash outlays for caretaker operations. Under accounting rules, impairment must be recognized when carrying value exceeds recoverable value. Recoverable value for a shuttered mega-project is based on estimated sale price. Broker opinions of value came in far below construction cost. Distressed property sales data suggested recovery might reach 30 to 40 cents on the dollar. The write-down was staggering. An $800 million asset became a $300 million asset on paper, possibly less in actual sale. The $500 million impairment flowed through to equity holders who saw their investment value collapse to a fraction of capital invested. Debt holders faced their own recognition. The loan balance was approximately $600 million. Recovery through foreclosure sale would likely yield $300 million at best. The lender faced a $300 million loss. These losses were economic reality catching up to financial statements. The value had never truly been $800 million except in the pro forma world of projected success. Actual value was always tied to cash-generating capacity. When operations failed, that capacity vanished, and with it went the value. Property taxes created an ongoing liability. Tax assessments are based on market value. Assessors would eventually adjust to reflect the building's distressed status, but the process takes time. For several years, property tax bills would arrive based on outdated valuations far exceeding current reality. Unpaid property taxes become liens with priority over other debt. The accumulating tax liability created another barrier to sale. Prospective buyers would need to settle outstanding taxes as part of acquisition, reducing the net proceeds available to debt holders. Environmental liabilities added complexity. A building in caretaker mode still requires proper management of utilities, waste, and systems containing refrigerants or other regulated substances. Violations could trigger penalties and remediation costs. Insurance became problematic. Vacant building coverage is expensive and includes exclusions not present in occupied property policies. Maintaining adequate coverage was necessary but costly. Allowing coverage to lapse created catastrophic risk if fire or severe weather damaged the unoccupied structure. The carrying costs of an idle mega-project accumulated relentlessly. Property taxes, caretaker operations, insurance, and debt service if payments continued totaled approximately $6 million annually. This burn rate consumed any remaining equity and increased lender losses monthly. Sale efforts began immediately. The lender wanted to minimize loss through quick disposition. Brokers marketed the property to investors with turnaround expertise, alternative use developers, and liquidators. Interest was minimal. The building was wrong for most alternative uses. converting to residential faced zoning barriers and massive modification costs. Repurposing for industrial use was impossible given the design. Demolition and land value recovery was considered, but the costs exceeded likely land sale proceeds. The few offers that emerged came in far below the lender's outstanding balance. Each offer represented a choice between a massive recognized loss, now versus ongoing carrying costs, and the hope that market conditions might improve. Time favored neither holding nor selling. The building deteriorated in unoccupied status despite caretaker maintenance. Deferred maintenance during the operational struggle had left systems in marginal condition. Idle equipment degrades faster than maintained equipment in service. The physical asset declined, while the financial liability persisted. Every month added to the loss. Every year made recovery more distant. Bankruptcy filings formalized the economic failure. The owner entity lacked assets to meet liabilities. Creditors filed claims. Proceedings would take years to resolve and recover pennies on the dollar. The mega-project had transformed from ambitious vision to cautionary tale. A completed, functional facility now stood empty. Not because it was badly built, but because the economic logic underlying it was flawed from the start. Saving the project required breaking its original logic. Multiple rescue attempts were launched during the descent. Each followed predictable patterns. Each failed for fundamental reasons that couldn't be overcome with creativity or capital alone. The first rescue approach was the capital injection. Investors were approached to provide fresh equity to fund aggressive leasing while covering operating losses. The pitch emphasized the quality of the asset, the inevitability of market recovery, and the opportunity to acquire position in a distressed but fundamentally sound property at a discount. Sophisticated investors saw through this narrative. The building wasn't distressed due to temporary market conditions. It was distressed because it was fundamentally wrong for the market at the cost structure required for viability. No amount of additional capital would change the fact that the facility was too large, too expensive to operate, and positioned for demand that didn't exist at the required scale. Capital providers demanded returns commensurate with risk. The risk level for this rescue was extreme. Required returns were correspondingly high. Projections couldn't support those return requirements, even under optimistic scenarios. The math didn't work. Government bailout represented another attempted rescue path. Local officials recognized the employment and tax implications of failure. State economic development agencies saw the political cost of a high-profile collapse. Incentive packages were assembled. Tax abatements were offered to reduce operating costs. Infrastructure improvements were promised to enhance access. Marketing support was pledged. The incentives had value, but couldn't bridge the fundamental gap between revenue-generating capacity and cost structure. Public subsidy of private commercial real estate faced political constraints. Taxpayer funding of a facility primarily benefiting corporate tenants triggered opposition. The amounts required to materially impact viability were too large to justify given other public needs. Repositioning strategies were explored. Could the building be converted to alternative uses that might generate higher revenue or lower operating costs? Hospitality, medical, educational, and mixed-use configurations were all studied. Each alternative faced conversion costs that exceeded likely value creation. The building had been designed specifically for its original purpose. Fundamental systems and layouts didn't adapt easily to other uses. Conversion would have required demolishing expensive existing build-out to make way for different configurations. Zoning created barriers to many alternative uses. The site was approved and permitted for the original purpose. Material changes would have required new approvals through processes that were time-consuming and uncertain. Neighbors who had accepted the original development might oppose alternatives with different traffic or operational patterns. Strategic partnerships with operators who might bring expertise and tenant relationships were pursued. Property management firms, industry specialists, and institutional landlords were approached about taking over operations in exchange for equity stakes or fee structures tied to performance. Potential partners conducted due diligence and reached the same conclusions the original developers were facing. The economics didn't work. Taking over operations didn't change the fundamental mismatch between the building's cost structure and achievable revenue. Partnerships founded on the inability to construct viable business models. Debt restructuring negotiations attempted to reduce the burden of debt service to levels that operating cash flow might cover. Lenders were asked to accept reduced payments, extended terms, or conversion of debt to equity. Lenders had limited incentive to restructure. The building was collateral for their loan. Their recovery depended on sale value, not operating performance. Restructuring to facilitate continued operations might delay recognition of loss, but wouldn't improve ultimate recovery. Lenders preferred to foreclose, sell, and move on. Crowdsourcing and public campaigns attempted to generate community support and alternative funding. Appeals to civic pride, economic development narratives, and nostalgia for the original vision were deployed. These efforts generated attention but not capital at the scale required. Individual contributions couldn't approach the millions needed monthly to sustain operations. Corporate sponsorships were explored, but corporations make rational return calculations that couldn't be satisfied here. Every rescue path encountered the same bedrock reality. The project required a specific level of revenue to be viable. That revenue required occupancy and pricing that the market wouldn't deliver. No amount of restructuring, repositioning, or refinancing could change this equation. The original logic was that scale would create efficiency, and market demand would absorb the capacity. Both assumptions proved false. Scale created complexity costs that overwhelmed efficiency gains. Market demand existed at levels far below required capacity. Breaking the original logic would have meant accepting the project as misconceived from the start. It would have required writing off most invested capital and completely reimagining the purpose and operation of the facility. No stakeholder was willing to accept that conclusion until forced to by complete failure. The rescue attempts were all efforts to validate the original vision through modifications at the margin. What was required was acknowledgement that the vision itself was flawed. That acknowledgement came too late to save anything. This project isn't ruined, it's preserved without purpose. The post-shutdown phase created a strange tableau. The building wasn't abandoned in the conventional sense. It wasn't left to decay or vandalism. Caretaker operations maintained minimal functionality. Security teams still patrolled. Smaller in number, but present. They monitored cameras, checked access points, and documented conditions. Their purpose wasn't serving tenants, but protecting the asset from theft, vandalism, and unauthorized access. Climate systems ran on reduced schedules, not to maintain comfort, but to prevent damage. Temperature and humidity swings controlled to slow, deterioration of interior finishes and building materials. The systems cycled through minimal operations, burning energy to preserve an empty shell. Landscaping continued at reduced frequency. Grounds were kept from complete wildness not for aesthetics, but to maintain property values and comply with municipal codes. Overgrown landscaping would have signaled abandonment and triggered code enforcement. Essential maintenance proceeded. Roof leaks were repaired to prevent water intrusion. Mechanical failures that threatened building systems were addressed. The maintenance was reactive and minimal, doing only what was necessary to prevent compounding damage. Elevators were maintained and tested to remain operable even though almost no one used them. Fire suppression systems received required inspections. Emergency lighting and exit signs remained illuminated. The building maintained code compliance despite serving no occupants. Utility bills continued arriving. Electricity for minimal. Systems, security, and caretaker operations. Water for fire suppression and basic needs. natural gas for minimal heating. The costs were a fraction of operational levels, but still substantial for a building generating zero revenue. The monthly carrying cost settled at approximately $400,000. Annually, maintaining the empty building consumed nearly $5 million. For comparison, operational losses had been running $14.4 million annually. Shutdown saved roughly $9 million per year, but still burned capital relentlessly. This caretaker status created a kind of limbo. The building was neither operational nor demolished. It existed in suspended animation, preserved but purposeless. The state could persist indefinitely as long as someone continued funding the carrying costs. That someone was increasingly unclear. The owner had no remaining equity. The lender had foreclosed but hadn't found a buyer. Government had no interest in acquiring a white elephant. The building sat in legal and financial limbo while entities argued over who bore responsibility for what. Periodic tours were conducted for potential buyers. Brokers walked prospects through empty floors, demonstrating build quality and systems functionality. The tours generated expressions of interest, but rarely actual offers. The building became a landmark of a different sort. Not a triumph of development, but a cautionary monument. Local residents drove past and pointed it out. Media occasionally ran anniversary stories. Architecture students visited to study what had been built and why it had failed. Inside, the spaces remained largely as they were during operations. Reception desks stood unmanned. Conference rooms held tables and chairs waiting for meetings that would never occur. Lobbies maintained their finishes, gleaming in emptiness. The preservation was meticulous in some ways and deteriorating in others. Visible public areas were kept presentable to support sale marketing. Back-of-house areas and upper floors showed signs of neglect. Dust accumulated. Minor damage went unrepaired. The building began the slow process of decline that affects all structures denied active use. What remained was a shell. Functional systems, intact architecture, and complete infrastructure all waiting for a purpose that might never arrive. The mega-project had become a museum of its own failure, not ruined but unutilized, not collapsed but suspended. The question lingering in empty corridors was whether this fate was unique or representative of something larger. This failure repeats more than anyone admits. The mega-project's trajectory from ambitious vision through completion to abandonment wasn't unique. Similar patterns have played out across different markets, property types, and economic cycles. Shopping malls built in the 1980s and 1990s represented mega-project thinking applied to retail. Developers projected suburban growth, consumer spending, and anchor tenant stability. Many opened, successfully and operated profitably for years. Then e-commerce shifted shopping behavior. Anchor tenants failed, mall traffic declined. Operating costs remained high while revenue fell. Dozens of malls now stand partially or completely vacant, too expensive to maintain, too difficult to repurpose. Office towers in secondary markets followed similar logic. Developers bet on corporate relocations and regional economic growth. Buildings were designed for full occupancy and efficient operations at scale. Actual absorption came slower than projected. Operating costs consumed cash flow. Economic downturns reduced demand further. Many towers operate decades later at fractional occupancy, unable to cover costs, but unable to justify shutdown while any tenants remain. Convention centers and sports facilities built with public financing often experience operational struggles. The business cases projected utilization rates based on optimistic demand assumptions. Actual event bookings fall short. Operating costs exceed revenue. Ongoing subsidies from government become necessary to prevent closure. The facilities remain open through political will rather than economic viability. Residential mega-developments in markets like Dubai and China experience the pattern at massive scale. master-planned communities with thousands of units launched based on projected population growth and luxury demand. Construction completed, but absorption stalled. Entire neighborhoods stand empty. Maintenance costs continue. Values have collapsed. The projects exist in indefinite holding patterns. The common elements across these failures reveal structural causes. Scale assumptions that proved optimistic. Projections assumed market absorption at rates and prices that reflected peak conditions rather than sustainable trends. Cost structures built for full utilization. Fixed costs and operational complexity created expense baselines that required high occupancy to support. Inflexibility in the face of market shifts. Megaprojects are difficult to adapt or downsize. The physical plant and financial structure resist modification. Time delays that allow conditions to change. From conception through planning, financing, and construction, megaprojects consume years. Market conditions during planning may not persist through completion. Concentration of risk in single assets. Conventional development spreads risk across multiple smaller projects. Megaprojects concentrate risk in one location and concept. Agency problems between developers and capital providers. Developers earn fees during construction regardless of operational success. Their incentives align with project completion rather than long-term viability. These patterns suggest the failures aren't primarily about execution. Competent teams with adequate capital are still building projects that ultimately can't sustain operations. The problem is structural and systemic. Real estate markets have difficulty pricing and absorbing mega projects. The supply arrives in lumpy increments that can overwhelm localized demand. Conventional market analysis based on historical absorption doesn't account for the market disruption the mega project itself creates. Financial models systematically underestimate operational risk. The focus during development is on construction risk and lease-up timing. Operating cost variability and revenue volatility receive less attention. This creates systematic bias toward over-optimistic projections. Institutional capital has limited tools to evaluate mega-project risk accurately. Comparative analysis relies on historical data from smaller projects. The unique characteristics of mega-scale developments aren't well captured in standard risk frameworks. The frequency of mega-project failures suggests this isn't a problem of bad actors or incompetence. It's a problem embedded in how mega-projects are conceived, financed, and evaluated. The pattern repeats because the incentives and information problems that produce failure haven't been resolved. Until they are, more mega-projects will follow the same trajectory from ambitious vision to operational crisis. But recognizing the pattern isn't the same as understanding its purpose. The project succeeded, just not as a place for people. The final question: what did this mega project actually accomplish? From a conventional perspective, it failed. The building doesn't serve its intended purpose. Tenants didn't materialize at required levels. Operations couldn't sustain costs. Capital was destroyed. Investors lost money. The outcome by any business metric is failure. But business metrics capture only one dimension of what mega projects actually do. During the development phase, the project employed thousands. Construction workers earned wages, suppliers sold materials, engineers provided services. Money flowed through the economy for years. Those economic effects were real regardless of post-completion operational failure. Professional firms billed millions in fees. Architects, engineers, lawyers, accountants, and consultants all generated revenue from the project. For these service providers, the project was highly successful. Their compensation didn't depend on operational outcomes. Government collected taxes throughout, property taxes during construction, sales taxes on materials and equipment, payroll taxes on workers. The revenue funded public services regardless of whether the building ultimately operated profitably. Financial institutions earned fees on lending. loan origination fees, interest during construction, and various service charges all compensated lenders for participation. Even in foreclosure, lenders recovered significant portions of their principal. The loss was real but not total. Developers and their principals extracted value through development fees and promoted interests. Their compensation was weighted towards the development phase rather than operations. They profited even as equity investors lost money. For many stakeholders, the project was a success that delivered intended outcomes. Employment, fees, and economic activity all materialized as planned. That these benefits came at the cost of equity destruction and operational failure was someone else's problem. This distribution of outcomes reveals what mega projects actually optimize for. Not long-term operational success, but short-term activity generation. The project succeeded as a vehicle for fee extraction and economic activity. It failed as a sustainable operating business. The distinction matters for understanding why mega projects continue being built despite high failure rates. The parties with decision-making power and influence over project approval aren't primarily bearing operational risk. They're capturing development phase benefits. Equity investors bear the operational risk, but participate later in the process after key decisions have been made. Their ability to influence project conception and structure is limited. By the time equity commits, the project's fundamental characteristics are largely determined. This creates a systematic bias toward projects that maximize development phase activity, even if that creates operational challenges. Bigger projects generate larger fees, more employment, and greater economic impact during construction. The operational consequences of that scale emerge only later. Government participation reinforces this bias. Politicians benefit from announcing large projects that promise jobs and economic development. Ribbon-cutting ceremonies happen at completion, not at operational stabilization. The political cycle doesn't extend long enough to create accountability for operational failure years later. The media coverage follows similar patterns. Construction of mega-projects generates positive stories about growth, investment, and vision. Operational struggles emerge gradually and lack the dramatic appeal of groundbreaking ceremonies. The narrative arc favors announcement over outcome. From a societal perspective, this creates value destruction disguised as development. Capital is consumed building facilities that can't sustain operations. Resources are misallocated to projects that don't serve enduring needs. The opportunity cost is substantial. That capital and labor could have produced things of lasting value. But from the perspective of individual participants, the incentives are rational. Each actor pursues their own interest within the system's structure. The system produces mega projects even though the aggregate outcome is often negative. Changing this pattern would require restructuring incentives to align development phase participants with operational outcomes. Fee structures tied to long-term performance. Financial models that properly weight operational risk. Approval processes that demand realistic absorption and cost projections. These changes face resistance from parties benefiting under current structures. Developers prefer fee models that pay during construction. Lenders prefer short-term loans that exit before operational risk fully materializes. Government prefers projects that generate immediate activity over long-term sustainability. Until incentives change, the pattern will continue. Mega projects will be conceived based on optimistic assumptions. They will be built with competence and care. They will open to fanfare and expectation. And many will quietly fail operationally while declaring success for everyone except equity investors and the communities left with empty monuments. This mega project succeeded as a vehicle for extracting fees and generating activity. It failed as a sustainable place for people. Both outcomes were built into its structure from the beginning. Understanding which was really the purpose requires looking past stated intentions to revealed priorities. The building stands empty not because Anyone made mistakes, but because it performed exactly as the system designed it to perform. What remains is a question for societies to answer. Is this an acceptable outcome, or does it reveal something broken that deserves to be fixed?